Yesterday we have the last topic. What we have done was what is trade discount, what is cash discount, how do we account for, and what's the meaning of it, and how these discounts are accounted for in the books of accounts. Trade discount is not recorded at all. Only uh, maybe a mention would be made that a discount at the time of purchase or sale was received or given. That's it. Other than that, as part of the journal entry, trade discount will never appear. But that's not the case with cash discount. Cash discount, since the original transaction is already recorded at the original price or the listed price, if there is a discount given or received at the time of payment of cash, then how much discount was given will appear in the books of accounts as an item called as discount received or discount allowed. Okay. So what's the reason why cash discount is allowed? Yesterday I did give you the explanation. What is the intention behind giving the cash discount by the seller to the buyer is to collect the cash amount, because cash is required to settle other liabilities or other expenses are to be met. Therefore, to collect the cash from the customers at a earlier date, cash discount facility is provided by the seller to the buyer. Let's go to the next one. Sales tax. Sales tax is an indirect tax. When the seller sells the products, the price is inclusive of a tax amount which the seller is collecting from the buyer and takes up this responsibility of making this tax payment to the government. So the sales tax, while deciding the price of the product, that amount of tax, whatever is there, would be added to the price of the product, and then we would see that what is the total price of the product. So the price, the total price of the product is after adding the sales tax, and then the price that is offered to the customers is the total price. This is collected by the seller. This amount is collected by the seller, but it is not his revenue, or he would not be enjoying that. But this will be later on, after at the end of the period, the seller will have to remit it to the government or pay it to the government. This is sales tax. Now that is included into the price that is offered to the customers. What's the accounting treatment of that? Now, sales tax is levied on the final consumer of a product. It is an input tax, sales tax charged on purchases by suppliers. If the supplier is collecting from the business, it is an input tax. Otherwise, it is collected from the customers by the business, it's an output tax. Now, how would it be treated? Now, when sales tax is collected by the seller, he has a responsibility, he has a liability to discharge it to the, or pay it off to the government. So until the sales tax amount is paid, that would be um, a liability for the seller. The sales tax is payable by the business to the tax authorities. Till the amount is settled, this portion of the price, which is sales tax, that portion will appear as a current liability. I have not explained to you the meaning of current liability, but you just remember that it is a liability appearing on the liability side of the balance sheet. This portion is not revenue for them. So though it is collected as part of selling the product, this portion is not revenue. This is just an amount collected from the customers, which again they would be paying it to the government. So this is part of indirect tax. How to calculate that? Sales tax is charged at a variety of rates. Usually, the ones most commonly used rates are these rates. Okay. How is the price decided? If a business entity is registered for sales tax, the sales and purchase day book must include entries to record these transactions. Let's say if it is 20%, so there's an illustration given here. Let's say if the rate is 20%, if the price of the product is, let's say it is 100, and if the tax rate applicable is 20%, the total price that is charged to the customers on the product would be 120. So whatever is the price on that, add a percentage of sales tax, whatever is the rate that is applicable, add that and decide what is the total value of the selling price or total value of the product charged as selling price, decide that and charge it to the customer. Collected from the customer, the total amount is collected from the customer, but how is it recorded? That also, let's look into that. How is it recorded? What is input tax when it is paid on purchases to the supplier? That is an input tax. But if it is collected from the customers on the goods sold, it is output tax. So input tax, how is it recorded? Okay. We see that the cost of the product, okay, the cost of the product plus the sales tax. There are two aspects of it. The total price that is paid on the product as purchases is made up of two components, the original cost of the product and the sales tax together. Added together, that would become the total purchase value payable to the supplier. Whether it is paid, then it would become cash. If it is payable, if it is due, it's still not cleared, then it would appear as payable. This is when the tax amount is paid on the material purchased from the supplier. So that's a journal entry, basic journal entry. Now, from a seller's point of view, if the business is the seller and the amount is collected, now the business has a responsibility to pay the sales tax to the tax authorities. So collection wise, they would collect it, the total amount of cash, or it is receivable, and that would be debited as against the credits of the price of the product, which is recorded as sales revenue, and the portion of the gross sales value, which is sales tax, is recorded as sales tax. This is not revenue. This is a liability for the business. Revenue, sales revenue, that would be only the net price of the product. Let's say if it is 120, 100 would be revenue for the business, 20 is a liability, because though it is collected from the customers, it has to be paid to the government or the tax authorities. So the journal entry is receivables or cash amount if it is already collected in the form of cash, to sales revenue, to sales tax. Now, what is done with this portion of sales tax? Now, this has to be paid, so sales tax to cash, it is settled. Sometimes some excess amounts, if they are paid or on adjustment on calculation, something, some portion of it may come back. So that, and when that comes back, so debit what comes in, if there is a refund, refund of input tax, whatever is paid as part of, I mean, if it was refunded, so cash is received, okay, credit sales tax amount that is received. The sales tax which was earlier debited on purchase of it, when it was refunded, because now this time the on purchase only there was a payment. So now when it is refunded, it would be received back on account of sales tax amount. Basic journal entries, but this is a concept what we need to just understand about how sales tax is included into the price of the product. By any chance, if I don't look at the waiting room, I mean the list, please hint me that somebody is there in waiting room. If your friends inform you. I keep looking at the participants list, but by any chance, if somebody is there in waiting room, please let me. I'll admit them into the question. So how is the item of sales tax accounted in the statement of financial position? Output tax is collected from the customers. Input tax is paid to the supplier. Output tax is collected from the customer. The collected amount will later on be paid to the tax authorities. Input tax is just paid to the supplier. Now, supplier will take care of making the payment to the tax authorities. Okay, so output tax compared with input tax could result in payment. Output tax will result in payment. There is a possibility that there could be a refund of sales tax. That's what we have seen. When there is a tax amount paid on purchases, there is a possibility that maybe some excess amount was paid. It was refunded back by the tax authority. So at that time, so there is a possibility for input tax as refund of sales tax. Where would they appear? Till the time the amount of output tax is not paid, so that is a payable, it's a liability, and it treat as a payable or payable in the balance sheet. Balance sheet, we call it a statement of financial position or SOFP. In the SOFP, it is a payable. If there is any refund on the tax amount paid as part of the purchases, if there is a refund, until it is received, so there may be an intimation that there is a tax refund, but it was not yet received as on the last day. Until it is received, it will appear as a receivable on account of refund of input tax. That's the treatment. Time permits at the end of the training session. If time permits, we will also look into one or two numerical questions, because there are certain, now that's only basic journal entries and then not not very difficult thing. Time permits, I will definitely do that. There are certain things like, now, how is inventory value? You would have not done any time before this, assuming that. I am not sure. Maybe in class 2 you must have done. I am not very sure about that. So how to treat inventory? I'll take you through one numerical question now in this class. Did you do any time how to value inventory? Any one of you?
Ma'am, do you mean cost of materials consumed or just inventory?
Cost of goods sold is that equation which is opening stock plus purchases minus closing stock. No. This is valuing the inventory. Okay, let's do this one. Otherwise, also, even if you have done also, I would do this. The next element of the financial statements is inventory. The inventory is the basic material that is purchased so that this can get converted into finished goods and the sales can take place. The main operation of the business is trading. Trading means buying and selling. So the operating activity starts with buying of raw material. Material is not purchased only one time or few times, but constantly there is the inventory is purchased multiple times. Very frequently they are purchased because the main activity itself is buying and selling. So they keep buying the material. See, material is always kept available in the stores department, because production, as it is an ongoing process, material should be continuously supplied to the production activity. So the products are produced so that the later part of the sales can take place, etc. So let's say that if there is one lot of material which is purchased, first lot of material. So first lot of material, maybe let's say this was purchased at 10 rupees per unit. So they would not wait until all the units in this lot are consumed that they go in for buying another lot. So even before this is consumed, They go in for buying another lot of material. This is second lot of material, because it has to be kept available all the time. So they do not wait until the last unit in the first lot is completely consumed and go in for buying another lot of material. The reason why they purchase beforehand is, see, there's something called as a lead time. Generally, when material is purchased, when an order is placed with the supplier, it is not instantly received. There is a procedure, so it takes some amount of time. Some amount of time, that is when the suppliers are called in to present their quotation. On receiving the quotations from different suppliers, then there is a supplier selected. One or few suppliers are selected, orders are placed with the supplier delivers the material is received and inspected for its quality, etc. It is moved into the stores department. The invoice, as against the invoice, the payment is made, etc. So that's a procedure. It is little time consuming. So it is time consuming, therefore even before this is completely consumed, they go in for placing an order. So this, by the time the second order is received, already there would be some more units there available in the first lot. Then the second lot is also received. Let's say that by the time within that days difference also, let's say that the rate of the material would have been increased to, let's say, 10.2. Now it is not just 10 rupees per unit, but now it has increased to 10.2 per unit. So we have material as such, it would be the same. Any number of units, it would be the same. But what value are we assigning to the ending inventory, the closing stock? How are we recording that? Would we charge 10 rupees or would we charge 10.2 for the number of units that are present as on that date? What is the treatment? The accounting treatment is what we have to learn. How do we treat that? So now, according to IAS 2, now the section you need to remember that IAS 2, according to that, the different methods that are used for valuing the inventory is, we have FIFO method, weighted average method, and lower of cost or net realizable value method. These three methods are followed in terms of valuing the inventory. The amount of inventory or closing stock, what we call, which appears in the trading account on the credit side and the balance sheet asset side. How do we arrive at that value? So that is what we have to learn. So let's learn that with the help of a numerical question. Your exam kit, in the exam kit, there is one question. So this is the question. Let's take this question to an Excel sheet. There we'll solve this one. Okay. The question goes like this. The ABC has closing inventory of 100 units at a cost of 4 per unit as of the 31st December 20x4. During the first week of January 20x5, they entered into the following transactions. 3rd January, additional units purchased are 120 units. Then we have the value at 4.50 per unit. Total value is this much. Then 4th January also they purchased units, 200 units at $5 per unit. And this is the value. 6th January, out of the available units, whatever they have, out of that, 280 units were sold at 7 per unit, and this is the value. Then 7th January, again they purchased. Okay, so multiple transactions took place during the first week of January 20x5. Now, in this case, calculate the value as per IAS 2 inventories of the closing inventory at the end of the first week using the FIFO method. The full form of FIFO is first in, first out. Whatever comes in first goes out first. So how do we account for the cost of the inventory if FIFO method is followed? FIFO, first in, first out. So that we will see. I'll take this question. We'll take the screenshot of this one, put it in Excel, and then solve that because rows and columns are all there. Um, I want all of you also to solve this one in your notebooks. Okay, you also be ready with the notebook, pen, scale, whatever you require. Let's solve this one. Now, the question is the at the beginning of this period, January, that's the close of December, they were on hand 100 units. The cost of these units is $4 per unit. So that's what is the available stock they have. Then later on, they purchased out of these things, some of the units are picked up and then they are sold. Then again they purchase. So at the end of this week, at the end of the first week of January, what is the value of remaining units or the ending inventory? What is the value of ending inventory is what we have to find out. So there are 4 bits which are asked here about calculate the value of the closing inventory if FIFO method is followed. After that, we see for the next bit, if the weighted average cost method is followed. Okay. Okay. Periodic weighted average cost method, continuous weighted average cost method, and there is one more bit which is asked if FIFO method is used, or in case of rising prices, which method is a better option is what is the question. So all the bits, let's solve them. How do we account for, what's the format like? The format I will do it that, but let's just talk about what's the format. See, there would be chronological order, it would be recorded. So there would be an entry for date column. The details are to be accounted for. See, whether it was a purchase or a sale, the details would be there. After that, we see that there are 3 columns. One talking about the purchases, goods that are received, or we talk about it as purchases. One set of uh, columns are for purchases. Another set of columns are for sale. And finally, we would see what is the balance. So 3 sets of columns would be there. Now, each of these columns again have sub-columns. Sub-columns for the number of units, the price or the rate per unit, and the total value. So, for all these 3, we would see 3 sub-columns. So, altogether, it would be 9 columns for the amounts that are recorded. We have one particulars, Then extreme end on the left side, there is a date column. So date column, the details column, that is particulars. Then we have 3 columns for purchases, 3 columns for sales, 3 columns for balance. So 9, 10, 11. So you should have 11 columns in your notebook. I'll reduce the size of this image so that we can accommodate so many columns here. So let's start with a date column. A bigger one, which has to write the details about the transactions. Then there is one column to account for the next set would be sales. The next set would be balance. Now in this first would be, we have units or quantity, rate per unit, and the amount, the value of those units that are purchased. The same I hope the image is clear to you. I reduced the size of the image. I hope it is clear to you.
Yes.
Okay, done. So the first transaction starts on the first date. The closing inventory as on December 31st is the beginning inventory as on January 1. So let's write the date. Date is 20x5. And then let's start with first one is January 1. So January 1, this is balance. Balance brought down. So in the balance column, how many units of balance was there? 100 units, each at rate of 4. And then we have the value as 4 into 100, 400. The next transaction took place on January 3rd. So 3rd January, the transaction is for purchase of goods. So goods received, the normal, there is a format called as goods received. Whenever goods are received, it comes with a note number. So the note number, the details are entered as goods received note number. Since it is a basic thing which we are learning here, we can just write goods received without writing the note number. We don't have the details about that. Or in simple terms, you can also just write, because the first time you're learning that, you can also write it as purchases. Normally, when goods are purchased, they are received. Those units are received with a note number which is sent by the customer. So that would be entered in the stores ledger. This format would be present in the stores ledger, the one which we are looking at. So that format, the note number also will be recorded. So that will act in future. Anything has to be verified. That number helps them to identify the transaction, etc. So that's the invoice number which is received. So right now, so you can write it as just goods received, or just write it as purchases. So that's perfectly fine. So now, how many units are received? 120 units are purchased. This time, the first lot of material what they had was at a value of 4 per unit. But this time when they are purchasing they are purchasing it at 4.50. So the value of these units is 540. So there are two lots of material. One lot has 100 units at 4 per unit, and the second lot has 120 units at 4.50. The technically speaking, all the units that are purchased received by the stores department would be dumped. There is no such distinct place that is um, provided for each lot of material. All of them would be dumped at one place. There is no difference as such about uh, the units that are received. But now here we see that there is a difference in how they would be accounted for. It is only an accounting activity that we are looking at. See, now here, if we are talking about the balance, if it has to be recorded, altogether we understand that there are 220 units. One is 100 units at 4 per unit, another lot is 120 at 4.50. Okay, two lots are there. Quantity wise it can be added, but see, the total value also stands at 400 is one value and 540 is another value, can be added and recorded, but there is a reason why they would not be added, but they are mentioned in the stores ledger separately. When we come till sales transaction, at that time you would realize. As of now I'm just writing as it is. This 100 units lot is one balance. Another balance is 120 units lot. Where are shapes? Where do we find shapes? These are shapes. Okay. I'll put a flower bracket to make to indicate that this is one set. That's now. This one. So this is all one transaction. It is not looking very obvious. I'll highlight it with a color, a lighter color. I will highlight it. Okay, this is one. See, as on January 3rd, we have two lots of material in the stores department. One at 100 units at a rate of 4 per unit 400. Another lot which is 120 units at the rate of 4.50 540. Now the next date is January 4th. January 4th also they have purchased again goods. This time the purchase was for 200 units and the price is, it's again another different price, which is 5 per unit. Just multiply and then we see that the previous balances are there. Apart from that, now they have received a third lot with a different price, which is, so this is the balance as on 4th January. Now comes 6th January. I hope all of you have made a note of this. Shall we proceed?
Yes, ma'am.
Okay. Now, 6th January, this time units are sold. Okay. Just write sales. Normally, we the units here it is directly given as sales, but the normal practice would be after goods are received, they would be required by the production department. So when the goods are sent to the production department, issued to the production department, when do they issue it? Whenever the production department sends a requisition. So on receiving a requisition from the production department, the units are sent to the production department. So there is an account, there is an entry for the units that are sent to the production department. Here in this case, we are given that units are directly sold. See, there is no conversion of raw material into finished goods, anything. Material is received, material is sold, it is sent out for sale. Otherwise, it is sent out to production department. Okay. So how many units are sold? 280 units. That is also fine. The 280 units are sold, so we would be accounting that. In this case, the units would be taken from altogether they have 100 plus 120 plus 200. This is 420 units are available in the stores department. Out of that, 280 units are sold. If 280 units are sold, what is the cost of those units that are sold? See, what cost should be assigned? The cost value of these units that are sold is what has to be accounted for, because when they are received, three different lots have three different prices. So the same price should be charged to the units that are leaving the stores department, that are going out of the stores department. See, any of these rates have to be assigned to those units. So for that, there are different methods. The first method here is FIFO method. Whatever comes in first, whatever lot comes in first, the rate which is present on that lot, that is the rate which should be charged to the units that are leaving first. First in, first out. So first in, first out says that when the units are issued out first or sold out first, so in that case, the amount that is charged to the on the goods would be based on whatever comes in first is goes out first. Sorry, I didn't tell you about the heading. It is stores ledger account, and the method that is followed is FIFO, first in, first out. FIFO, FIFO method. Okay, so 280 units. So the first lot should be taken, and the price of this first lot should be charged. But the first lot doesn't have 280 units. There are only 100 units in that first lot. So charge the rate as first account for 100. Then the rate is 4 per unit and the price is 400. First lot is completely consumed. Okay, so that is sold out. Next, take the second lot. Second lot is 120. So the requirement is for 280. So account for 120. This time the price is 4.50 and the value stands at 540. This is 100 plus 120 is 220. The requirement is 280. So some more units are there, which is how much more? 60 units more. So the next 60 units will be taken from the third lot, which has a price of 5 per unit. So this will be 300. So how much is remaining? Now their balance has, out of 200, if 60 are issued, so 140 units are remaining as closing inventory, and that has a price of 5, and this price of 5 into 4, 140. is 700. After that, they have purchased again goods on January 7th. This is goods received or purchases. Either ways you can write goods received 100 units and it is 5.50 and this is 5. The balance is already 140 units are there. Next, we see another set of units that are received. Any doubts in what we've done till now? Did you understand? Please respond. Did you understand? Please respond. Did you understand?
Yes, ma'am.
Any one of you has any doubt in any step, any stage?
Ma'am, can you come back to that 6th Jan sale third point?
January 6th. Okay, this one.
Yeah.
Okay. On January 6th, there was a sale for 280 units. So they sold it at 7 per unit, but that is not our concern here. See, um, we are accounting for, see, when the units were received into the stores department, they were received at a cost. Each lot has a cost. When they are sent out of the stores department, the cost of those units has to be accounted for. The same cost has to be accounted. The sale value will be accounted in the trading P&L account or in the sales book at their sales value. This is just a stores department maintaining a ledger account where when the units were received, what cost was accounted. When the units are leaving the stores department, what cost has to be assigned to those units is what is looked into. See, on January 6th, the total number of units that were sold are 280. So for these 280 units, what is the price that would be charged or what is the rate per unit which will be charged? But now we see that 280 in one lot is not available. Just before 6th January, the total balance which is available in the balance column, we see that there are 3 different lots. Each one of them has a different rate per unit. So what cost will be charged? Should they be charging it at 4 or 4.5 or 5? So now that is the confusion. What is the price that would be charged? So in that case, because the first method that we are learning here is FIFO method, first in, first out. So while assigning the cost to the units, whatever comes in first, the lot that has come in first with the rate per unit, that rate will be applied to the units that are leaving the stores department. But 280 units are not available in the first lot, only 100 units are there. So account for those 100 units at 4 per unit, which is 400. Next, the requirement is 280. So 100 is already accounted for, another 280. Then take the second lot, 120. So 120 has a rate of 4.50 per unit. So the value is 540. Now 100 and 120 together is 220. Requirement is 280. Therefore, take another 60 units out of the third lot, which is called as which has a rate as 5 per unit. So 60 units will be charged at 5 per unit, and then this 300. Out of 200, if 60 are issued out or accounted for the sale units, balance of the units are 140 units at the rate of 5,700. After 6, again on 7, they received again material on account of purchases. This time the rate per unit is 5.50. There are 2 lots of material that are available as on 7th January. One lot 140 at 5 per unit, another lot 100 at 5.50 per unit, which is 550. Is this clear?
Yes, ma'am.
All of you, did you make a note of that? Now let's take up the questions. Question number 146. Now this is what we have calculated. Now question number 146. Calculate the value as per IAS 2 inventories of the closing inventory at the end of the first week using the FIFO method of inventory valuation, round to the nearest full dollar. So what's the total value? Total value of the inventory, closing inventory according to FIFO method is, how much is that? So 1250. I'll make a mention here. Is equal to 700 plus 550, which is equal to 1,250. If this is clear, we'll go to the next method, which is weighted average. Please have a look at this one, weighted average. So there's another method. If it is P4, there's another method called as LIFO. Whatever comes in last is issued out first, LIFO. LIFO is followed as per GAAP, generally accepted accounting principles, but international IFRS financial reporting standards, international financial reporting standard, LIFO method is not followed. So we will not be learning about LIFO method as such, because the ACCA is ACCA is UK body, so and in UK it is IFRS which is followed. Therefore, we are not even learning about LIFO method, because that is not a method that is followed under IFRS. So we will not be learning about that. But any explanation relating to that, any time it comes up, I will talk about LIFO method. But numerical wise, we will not be learning about LIFO method. 147, question number 147 is about weighted average cost method. 148 is also weighted average cost method. So weighted average cost method, but it is one is periodic weighted average cost method. Another one is continuous weighted average cost method. When we have accounted for here, the way the entries are accounted, the recording of transactions that are taking place. See, chronologically we are accounting, but after every transaction, what is the balance that is available is accounted. So this is on a continuous basis, the valuation is taken up. They are not waiting until the end of that accounting period where the value of the inventory is calculated. But on a continuous basis, see, after writing every single transaction, the value of inventory is calculated. So it's called as continuous method, or we also call it as perpetual method of inventory valuation. Continuously, see, every single transaction, at the end of every single transaction, what is the balance that is available is accounted for. Another way of accounting the transactions is wait until the time the period ends. So here in this example, it is 1 week. So at the end of 1 week, just count the number of units that are remaining and um, find out what is the value. See, we are looking at the weighted average method. So what is weighted average method? The whole um, treatment, whatever is taken up is in terms of what price should be charged to those units that are leaving the stores department. That's the concept here, basically. See, when the units are leaving on account of sales or issued to the production departments, what price should be charged is the, now that's the criteria. Now, if that has to be met, when there are three lots in this example, when there are three lots, we have mentioned as three different lots. Another way is an average price also can be calculated. Average of 4 plus 4.5 plus 5 divided by 3, average also can be calculated, because technically the units would be the same. There is no difference in the units that are purchased. Which one would be issued also, there would be no differentiation as such. So the whole concept is about what price should be charged. So some of them take a simple average of calculating 4 plus 4.5 plus 5 divided by 3 gives them an average value which will be used, the price, that price will be used to issue 280 units. That is simple average. But another most reliable method is the weighted average method. What's the formula for weighted average? Average is mean, isn't it? So the weighted average is sigma Wx. W is the quantity, X is the price. Sigma Wx divided by cooling, you must have done. Hope you remember that. Sigma Wx by sigma W. So this is how the price is calculated. At that price, the units are issued. That is the price at which the units that are leaving the stores department, for that the price is assigned. Using the formula W into X, W being the quantity, X being the price, and divided by sigma W, that's the total quantity. So using this, the price is calculated, which is charged for the number of units that are leaving the stores department. So on a fresh page, again you start this format. Let's work it out for the weighted average method. Then again, weighted average. There are two different situations which are discussed here. What if it is periodic weighted average? What if it is continuous weighted average cost method? If these things are followed, how do we calculate that? So what do we do? Um, Because first it is the periodic is asked. I'll just first do that. This format goes for continuous. So let's answer question number 147 first. Do it in a fresh page if you have already prepared the format, if you have drawn the uh, lines. Take a fresh page and write bit number 147. Heading is periodic weighted average cost method. This does not require this big format. It's a simple calculation because at the end of the period, the calculation is done. So we do not require this format to be drawn. A simple average price calculation has to be done, and that would be charged to the number of units, that is 280 units, that would be charged. Okay. From the question, we see that um, periodic, I didn't write periodic weighted average cost method. So the value of inventory is calculated as on the last date of that period. They would not be doing on a continuous basis every single day. At the end of every single day, what is the value is not calculated, but they wait until the last date. Here in this case, January 7th is the last date of the first week of January. So on that date, they account for everything and find out at what price they would charge to the units that are sold. What is the price that would be charged to the units that are remaining in the stores department? Weighted average, already I did mention to you what is the formula. The formula is sigma Wx divided by sigma W. W is the quantity, X is the price, and okay. So take this one to calculate what is the average price. Altogether, there are 4 lots during this week. There are 4 lots of material. First one is 100 units at 4 at 4 per unit. The second lot received is 120 units at 4.5. Third lot that is received is 200 at 5. And the fourth lot is 100 units received at a rate of 5.5. Okay. Irrespective of whether the units that are received is after the sale transaction, all the units that were received during the period are considered to calculate the average price. See, of course, these 100 units are received after the units are sold. Ignoring that, because one full period is considered. During that period, how many units were received, how many units were sent out, what is the balance, that's all what is looked into during that period. So very intricate details about when was it received, so was there anything else received after the sale, etc., so that would not be looked into. So now first we have to calculate what is the average price. Weighted average price has to be calculated. So let's calculate weighted average price is equal to, so now we see that there are 4 lots. 100 into 4 is 1 lot, sigma Wx no, plus the second lot is 120 into 4.5. The third lot is 200 into 5. plus fourth lot is 100 into 5.5. That's the sum total of all the units that were received, sigma Wx. The entire thing divided by, we should have the total of the quantities. Quantities total is 100 plus, next one is 120, then again 200, then again we see 100 is received. So that is how the weighted average is calculated. Please do that. Do it on your calculator. So it is 4.788. Round to the nearest full dollar. Okay. Let's take round it off to 2 digits. After that calculation, let's try. Calculate the value as per IS2 inventories of the closing inventory at the end of the first week using the periodic weighted average cost method of inventory. So we need to find out what's the value of closing inventory. Value of closing inventory is equal to, how many units are there in the closing inventory? We see that there's one lot 140, another lot 100. 240 units are available in the stores department at the end of the first week. 140 and 100. 240 units are there. All these 240 units will be valued at a price of 4.79. So round it off to the nearest dollar, 1150. It is not asked, but I am just doing that. What would be the value of the units that are sold? Value of goods sold or cost of goods sold, if we have to calculate. Since in the FIFO method, everything is in detail given in that format, everything can be known. But here, of course, it is not asked, but still I'm doing. So what is cost of goods sold? If we are to find out that, that also will be the 280 units were sold. 280 units also will be charged at 4.79. That is 1341. 1341, 1340, and 1150 there. So that is how, if it is weighted, periodic weighted average cost method. I hope this is clear. Any doubts? Shall we proceed further? Now let's do 148. Question number 148. This is weighted average method, cost method, but this weighted average cost method is continuous weighted average cost method. Solve this one. The format which you have already drawn that in your notebook, use that one. Let's start. Write the beginning balance. Then on a continuous basis, the average value would be calculated. 1st January, 100 units at 4 per unit. Then we have it as the value as 400. Then next lot of units that are received. Okay. So when the next lot of units that are received, we see that account for that. See, the whole focus will lie here with the balance column. Okay. Um, Total it up, right? 220 units, 220. Find out the average price. How to calculate the average price? 400 is the value of the first one, that is 100 into 4 plus 120 into 4.5. So that gives 540. 540 divided by 100, 220. Sorry. So 540 plus 400 is also there. It is 940. 400 and 540, both of them are added together and then divided by the total number of units gives us. So the value stands here at this time. Next date is 4th January. Total number of units would be already 220 are there. Another 200 are received. So total number of units are 420. 940 is the value plus now 1000 is there. 1940 will be the total value of all the units that are received. Next date is there is a sale on 6th January. For how many units? The number of units that are sold is 280. So the cost of the units that are sold will be charged at 4.6. Round it off and make it as 4.62. So charge it at 4.62. So the balance is out of 420, 280 is issued out. So 140 is the balance. The price is 4.62, which is charged, and the balance of it. After this, again 7th January, they again received material. Another 100 units are received. Now altogether 240 units are there. The total value of the units is 646 plus 550. Okay. The average price would be continuously after every single transaction, the weighted average price is calculated. So that's the concept here. 4.9. So question number 148. Question number 148 says, find out the value of closing inventory according to continuous weighted average cost method. So value of closing inventory is 191196. Value of closing inventory is equal to 1190. I hope this is clear to you. What happens? Students left? Not interesting, boring, or anything? Did you understand? Please respond.
Yes, ma'am.
Understood? One more MCQ is there. Let's answer that MCQ. See, if you have made a note of all these things, I will move the cursor down. Question number 149. In accordance with IAS 2, in times of rising prices, which of the following will give a higher profit in comparison with other methods? So there are three methods that are mentioned. One is FIFO method, one is periodic weight average cost method, the other one is continuous average cost method. Which one would give a higher profit in terms of rising prices? In terms of rising prices. So prices are rising is every subsequent time the material is purchased, it would be purchased at a higher cost. So it is rising prices. In times of rising prices, prices are rising. When prices are rising, okay, in fact, actually, as per IFRS, LIFO method is not followed, but the best method that should be followed is LIFO because it's not part of our syllabus which has to be learned. So right now, so we are not considering. But what actually happens, I'm talking about that. See, when the prices are rising, every time the entry is made, if it is FIFO, for example, the prices are 4, 5, 6, something like this. When goods are issued out or sold, first this price will be charged, then comes this price will be charged next, and then it goes on like that. So the cost of goods sold, the cost that is charged to the units that are sold will be at lower price. Cost is low because the least one, because the first lot is selected, the first lot among the lots will have the lowest price because the prices are already rising. Cost of goods sold will be low. This will result in higher profits. Profits would be high. So profits would be high because cost is low, profits would be high. So advisable is instead of following FIFO, if they are following the gap, it is advised that LIFO should be followed. The question is only which one is the best method to follow. It's not about which one is the best method to follow, but which one will result in higher profits in comparison with other methods. FIFO will give higher profits in comparison because um, average cost methods are basically focusing on taking the average price. So uniformly, it would be the same throughout that period for all the units that are issued. So it is an average price which is calculated. But FIFO, while calculating the cost of goods sold, every time the cost of goods sold is calculated, from among the lots of material, the lower cost material, because the first ones have the lower, because the prices are rising, the lower cost is there for the first ones. Those cost is taken and charged to the units. So the cost of goods sold is low, and it will result in the profit being high. What's the answer? Answer is A. If it is clear, we'll go back to PPT and then solve the question, solve the other topics. I'm assuming it is clear.
It's clear, ma'am.
Okay. So we have another method called as, I'm going back to the PPT. We have another method called as lower of cost or net realizable value. The net realizable value is when the units are sold, whatever is the value that is realizable minus the selling expenses, any expenses that are incurred to realize that revenue, that is net realizable. There would be a cost, there would be a net realizable value. Between the two, whichever is lower, that will be assigned to the number of units which are there in the ending inventory. So cost is the cost at which the material is acquired as on the last date, whatever is the quantity of units that are available. What is the cost of that material is one thing. The other one is net realizable value. What is net realizable value is the on selling these units, whatever is the sale value minus any expenses that are incurred to sell these units. Basically, we call them as selling expenses. Any expenses incurred to sell these units. So for a sale transaction, when it happens, the sale value, the gross sale value minus the selling expenses gives us the net realizable value. So make a comparison between these two. Whatever is the lowest value, lower of cost or net realizable value will be the value of inventory if it is according to lower of cost or net realizable value. I didn't find question in this exam kit. Later on, I'll take up a question on lower of cost or net realizable value, and then solve a question. But right now, though it is in the examination kit, I have not found any question there. Let's proceed further with the other topics. Inventory in the statement of profit and loss, inventory would be accounted as part of cost of goods sold. So what is cost of goods sold or cost of sales? What we call it as cost of sales is the opening inventory plus the units that are purchased minus the closing inventory is the cost of sales, which is deducted from the total revenue to find out what is gross profit. In a T form, we would write it on both the sides of the account. In the trading account, we see that opening stock is recorded here. Then we have the purchases units that are purchased. There are few units that are sold. There are certain units that are unsold, which we call it as closing stock. The opening stock plus the units that are purchased and minus the closing stock will talk about the cost of the units that are sold. Okay, opening stock plus purchases, bring this to the other side, minus closing stock. So that is how it is accounted in the statement of profit or loss. So at the end of the year-end inventory adjustments, at the year end, two adjustments are required to recognize. One about the opening inventory, another one about the closing inventory. Opening inventory is the inventory which is brought from the previous period to the current period. So that is brought down. It is started with that note, that is the opening balance of the asset. Okay. Opening inventory in cost of sales to the inventory assets. Okay. Then unused or unsold inventory, closing stock. Unused inventory at the end of the year is removed from the cost of purchases. This would be deducted from the total cost. This is the total cost of the inventory which is accounted for. Out of that, deduct the closing value of inventory so that the total cost of the inventory can be accounted for. Cost of the units that are sold, that can be accounted for. So whatever inventory asset which was credited on account of the total cost of the units, that is the opening stock, then again purchases also. From that, this closing inventory is deducted to know what is the cost of the inventory that was sold during the year. Okay, so that is how it is accounted for inventory. Value of the lower of cost or NRV value, NRV, cost of the inventory. The cost that is spent to acquire the inventory is the cost of the inventory. Then NRV is the sale value which is realized minus any kind of an expense that is incurred to sell the units is deducted. So it becomes net realizable value. So between the two, whichever is the lowest, that will be assigned to the value of inventory. Okay, the two methods which are followed is one is FIFO. We have done both of them. Average cost method, ABCO, is average cost method. Okay, we've learned about how to calculate under FIFO, under weighted average cost method. It both periodic and continuous weighted average cost method also we did learn. I hope it is clear. Inventory valuation, then we can go to the other elements of financial statements. If inventory is clear, let's move to the next one. No response is coming. Only girls are there. All boys left. Just Riteja is there. Next element is assets and inventory is also asset. This time it is fixed assets. Fixed assets are also called as PPE, property, plant, and equipment. Property, plant, and equipment are fixed assets or non-current assets according to IAS 16. What would we be accounting for? Accounting for the cost of the assets that are purchased, the depreciation value which is charged against the asset value, when it is sold, the disposal, or when it is revalued. See, all four of them we would be looking into that. On this note, when we are talking about property, plant, and equipment which are non-current assets, how do we account for them? The first thing is they are purchased. When they are purchased, when business purchases two types of or takes a purchase of two different types of transactions. Whenever it is purchased on a regular basis, what does it purchase? It purchases the goods that are required or the material that is required to take up the operating activities. That is recurring in nature. Very frequently material is purchased. Another set of purchases are when the transactions are taken up, but they are not very frequent, irregular transactions. Very rarely they are taken up, and that is one point of difference. If it is regular in nature, we call them as revenue transactions or revenue expenditure. If they are irregular, very rarely they are taken up, we call them as capital expenditure. Another point of difference is the revenue expenditure which is incurred, the benefit out of that is for a short period of time. The benefit that is received from the capital expenditure is for a longer period of time, because the capital expenditure enhances the earning capacity of the firm. Material that is purchased can be, the benefit is short term. As soon as the units are sold, the benefit is realized. Let's say rent is paid. Rent paid, the benefit out of the rent paid or by using the accommodation is for a short period of time. Again, rent has to be paid for the next month, next period. Okay, the benefits last for a short period of time, whereas in case of capital expenditure, benefits last for a longer period of time, because the capital expenditure enhances the earning capacity of the firm. Okay, so property, plant, equipment falls under the category of capital expenditure because they are not very frequently taken up, they are irregular in nature, and on account of property, plant, and equipment, the earning capacity of the firm can be increased. So these capital expenditures appear as assets of the business because the benefit, the future economic benefit is yet to be realized. As long as it is not realized completely, that that portion of the asset will continue to appear in the books of accounts as an asset. So this is an asset for a long period of time, long-term asset, or we call them as fixed assets or non-current assets. You there with me? Any one of you?
Yes, ma'am.
Okay, good. See, that is what are the details that are held in on such a register typically include? We would have the details about these non-current assets of PPE, property, plant, and equipment, would have the cost of purchase, the date on which the asset is purchased, the details of the asset, the description, the serial reference number, location of assets, and then we look into what is the depreciation. What's the concept of depreciation? Why is depreciation charged on the assets, and the useful life and the carrying value has to be looked into. So now we need to look into what is the amount of depreciation that has to be charged? First is the purchase. The details about the purchase would be accounted for. After the purchase, depreciation has to be charged. What is depreciation? Any idea? You would have done in your +2, no? Depreciation.
Decrease in the value of the asset due to wear and tear or due to passing of time.
Okay, due to wear and tear or passing of the time, if the value of the asset decreases, that is called as depreciation. But what is the treatment of that? That would be accounted here in the statement of profit and loss or in the income statement. The P&L account, it would be accounted for. What? Why are we accounting that as an expense in the profit and loss account? The wear and tear value of the asset is, so why should it be reduced each year? Why not wait until the end of the life of the asset and settle that in one period? The logic that is applied here while the depreciation amount is charged to the income statement is that there is a principle in accounting called as matching principle. Matching principle says that the incomes that are generated should be matched with the expenses that are incurred to generate the income. So we are trying to match the amount of income versus all the expenses that are incurred. The expenses during the current period, like material is purchased, then we have so many production expenses, manufacturing expenses, then other things like operating expenses, rent, salaries, etc. So the list of expenses are all included or all totaled up. Then we have the total revenue, income minus expenses, profit. But there is also it's just not these expenses that are incurred during the current period. These expenses are not the ones which are enabling, these are not the only ones that are enabling the income to be generated. There are certain transactions that were taken up in the past period. Because of that also it was possible to generate the revenue. See, like plant machinery that is purchased because of the use of plant machinery and other fixed assets. Because of the use of those assets, it is possible to earn revenue because the production happens on plant machinery or there is a premises building is there which is enabling them to take up the activity. So all these assets are enabling the firm to generate revenue. Therefore, that portion of cost of the assets which is enabling the firm to generate revenue, that portion should be charged to the income statement in the form of depreciation expenses. Depreciation expenses, because it is used to that extent, that wear and tear value, it is used to that extent. So that wear and tear value, which we call it as depreciation, is accounted as an expense, which was in which was also one reason to generate the revenue. So we include depreciation expenses also as part of the expenses incurred in the current year. In fact, actually the cost was incurred in the past. It is not incurred in the present. But because of the use of the asset, it was possible to generate revenue. Therefore, that portion of the asset, which we call it as depreciation, is charged to the income statement. There are many methods of calculating depreciation, but here, according to your syllabus, only two methods are discussed. One is straight line method and the other one is reducing balance method. Okay, how to account for the cost of the assets? What all are included into the cost of asset is just not the price that is paid to the supplier of the asset, which is considered as cost. But all those expenses that are incurred at the time of purchase and installation of the asset um, in the firm, in the factory, would be part of the total cost of the asset. So the purchase price that is paid to the supplier plus to transport this asset from the supplier's place to the factory or the business place, any kind of a transportation, delivery charges, freight, etc., also will be added to the cost of the asset. Any amount of legal fees that was paid, any kind of a other expenses which are incurred to enhance the improvement of the asset will be become part of the cost of the asset plus trailing and testing. All these things, installation, erection, delivery, freight, transportation, legal charges, anything which is incurred to enhance the earning capacity of the asset, all of them will form part of the cost of the asset. So complete set of items together will be the cost of the asset, which will be accounted as the asset value in the statement of financial position. In relation to the fixed asset, the property, plant, and equipment, other expenses which do not which are regular, very frequently they're taken up, and they do not enhance the earning capacity, like repairs, renewals, repainting, administration, general overheads, training cost, wastage, etc. These are very frequently they take place. So these amounts are not capitalized, but they are charged in the income statement and deducted as expenses in the current period. So these are the costs in relation to property, plant, and equipment. How do we account for what's the journal entry? When the asset is purchased, asset is a real account, debit what comes in. So the asset account is debited, and what goes as against that, if cash is paid, cash goes out, or there is a liability that is created on account of payables. Okay. So asset account, debtor to bank or cash or payables if it is on credit base. Payables is a representative personal account. It represents the supplier who has given the asset on credit basis. So depreciation, the definition of depreciation according to IAS 16 para 6 says that depreciation is the systematic allocation of the depreciable amount of an asset over its useful life. What is that depreciable amount? Is the cost of an asset or other amounts substituted for cost less its realizable value is the depreciable amount. What is the other realizable value? That is, if it is sold on sale of the asset, if there is some value which can be realized, we call it as scrap value or salvage value at the end of the life of the asset. After deducting that from the total cost of the asset, the difference between these two is called as depreciable amount. Two methods. The two methods, first is straight line method. The cost minus any residual value is depreciable amount, this part of it. So this depreciable amount divided by the life of the asset is the amount of depreciation charged according to the straight line method. If it is reducing balance method, each year the amount of depreciation is deducted from the cost of the asset. Whatever is the balance of the amount or the carrying value of the amount, on that again depreciation will be calculated. So year after year it goes on like that. The methods of calculating depreciation. Since you have worked out these questions in your +2, I'm not solving even one question on this one. If time permits at the end of the training session, if there is still some time available, maybe we will take it up one or two example questions. But because this, you know how to do this one, therefore I'm not solving any numerical question on depreciation. Okay. The journal entry for depreciation is an expense which is charged to the income statement of profit and loss account. Two, we know that the asset account will be reduced on account of depreciation. So you must be knowing about the journal entry that depreciation expenses to asset account. But here in the journal entry, we see that there is something else that is mentioned, which is accumulated depreciation. The accumulated depreciation is, I'm just putting here the key form of the balance sheet. We see that the asset appears on the asset side. The property, plant, equipment appears on the asset side. So some value. See, whenever the depreciation amount is charged, so this depreciation amount is deducted from that and the asset value reduces. We would see the net value of the fixed assets is a decreased value. Instead of reducing the depreciation amount from the asset each year, another alternative practice is asset will be shown in the books of accounts at their original cost. So the cost of the asset will appear on the asset side as it is. The original cost of asset. The total cost will be as it is. Instead of reducing the amount of depreciation, the depreciation amount will appear on the liability side as accumulated depreciation. So every year the amount of depreciation that is calculated is accumulated into this account. See, the net asset will be the asset, the cost of the asset minus the total amount of accumulated depreciation gives us the net asset. But by presenting it here, we would see that the balance sheet, the total side of the asset side would be at an inflated value. Otherwise, if the depreciation is deducted, it is all reducing year after year. By following this practice, we would see that the assets will be at their original cost, but the total amount of depreciation that is charged as against the asset is appearing on the liability side as accumulated depreciation account. Okay, so whenever depreciation is calculated, that is credited to, that is charged to the accumulated depreciation account. So net asset, the value of net assets at any given point of time would be the total value of the asset on the asset side minus the accumulated. Okay. On disposal, so on sale of the asset, when the asset is sold, asset would be going out and then cash or the receivables will be coming in. So when the asset is disposed, a number of entries are required to remove the asset and associated. So there is a T account that is prepared. We would have it like this. So there would be some opening balance of the asset value. Opening balance, some value would be there. The total amount of depreciation that was charged on the asset would be deducted. Okay, then we understand what is the carrying value. So the total accumulated depreciation on the asset that is sold. So the difference between these two is the carrying value. So for example, let's let's take a very basic example. Let's say the original cost of the asset is 1 lakh. During the lifetime till the date of sale, the total depreciation that was accumulated, let's put it as 60,000. So what's the carrying value of the asset? The asset now will have it as 40,000. 1 lakh minus 60,000 is 40,000. The value of 40,000 indicates that when the asset is sold, it will realize 40,000. Okay, so now cash, because it is sold, cash would be realized, cash or receivables. That should be equal to 40,000. Cash value plus accumulated depreciation should be equal to the beginning value of the asset. So if it is 1 lakh, it is 60,000 here. The sale value should be equal to 40,000. If it is anything less than 40,000, let's say if it is only 38,000, it is 2,000 less, that 2,000 becomes loss. So here we would have it as loss, if any, if the cash value or the sale value is less than the net value of the asset or the carrying value of the asset. So if any, there could be a loss, or the as we are looking into the example, the carrying value, if it is 40,000, they'll receive anything less than 40 is a loss. There is also a possibility that they may be receiving more than 40,000. Let's say it is 45,000, 5,000 becomes their gain. So gain would be debited to the asset account. Gain, if any, will be recorded and the asset would be closed because the asset is no longer there because it is disposed of. Okay. So if any gain is there, that would be debited to the asset account and the asset would be closed. That is on disposal. Any loss or any gain will be carried to the statement of profit and loss account. When is there a gain or loss? If proceeds or the sale value is greater than the carrying value, there is a gain. Carrying value, if it is 40, they realize 45, 5 will be gain. If it is 40 carrying value, they receive less than that. So this carrying value is 40, but the proceeds are less than that, which is let's say 38. The difference of 2,000 is a loss. Both, if whatever, whether it is gain or loss, should be taken to the statement of profit and loss account. If it is both of them are equal, the carrying value and the sale value are equal, there is neither a profit nor a loss. Okay. Disposal of non-current asset, original cost, accumulated depreciation, disposal, that sale value. If this is less than the carrying value, there is a loss. Otherwise, there is a gain. Journal entries. Okay. When there is a disposal by cash consideration, so it would be cash to disposal of the asset account. Okay. When the asset is purchased, asset to non-current asset, so it would be accounted there. The total amount of depreciation, accumulated depreciation is charged to the asset account, the cash amount which is realized. If it is by part sale, we would proportionately calculate the accumulated depreciation, charge it, find out for that portion of the asset, any kind of a gain or loss and what is the amount of cash that is received on account of disposing that. Okay. Revaluation, I will do it tomorrow. Until now, is that clear what we've learned? I know the pace is very fast, but the number of hours of training that are allotted for this paper is only 20. So in 20 hours, if I have to do one paper, I think this is the only pace that can be followed. Anything slower than that, I will end up not covering the syllabus. So any topic which is a new topic, I will work out a numerical question. But by any chance, vaguely also, if you have done in your +2, I'm not touching on that. I'll explain what is revaluation of non-current assets in tomorrow. Tomorrow we don't have a class. No, tomorrow is Friday. No, tomorrow we have a class. Yeah, tomorrow's class I will explain that. I hope that is clear.
Yes, ma'am.
Okay. So any doubts? Otherwise, I'll wind it up. Okay then, assuming no doubts. I'll meet you tomorrow. Good night.
Thank you, ma'am.